Welcome to the M&A Unplugged podcast. Our mission is to help you be better prepared for your business acquisition or sale. Being prepared will ensure you maximize returns and minimize risks. This is M&A Unplugged with your host, Domenic Rinaldi.
Hey folks, welcome back to M&A Unplugged. I'm your host, Domenic Rinaldi. Today I'm going to talk about COVID impacted companies and some of the challenges that we're seeing now with actually getting those companies financed. What we're starting to see is that companies are coming out of the pandemic. They're starting to show some improvement, and there's activity on those companies. But getting them financed has been a real challenge. And so I'm going to bring you through some of the things that you need to think about. I have a couple of live examples that I can share with you so that you can understand, exactly what's happening. And, this episode, whether you're a buyer or you're an owner of a business and contemplating selling, you need to understand how the banks are viewing these deals and what's happening. And it's honestly a shifting landscape. We both deals that we're looking at right now that I'm going to mention have different issues, but the banks are being very cautious. They really want to see that the businesses are returning to the pre-pandemic levels, even going as far as saying that they like the deal, but they're not willing to finance it and close on it until they actually see that the business has a good track record of recovery, month over month improvements. So we're going to get into a bit of that and what you need to be looking for and how to be better prepared. Before we do, though, I've been talking to a bunch of buyers recently who are just stuck. They're stuck understanding how to do diligence, especially on companies that have been impacted by COVID, whether the impact was a positive one or a negative one. And we all know that there are some companies that did really well through COVID and others who have really struggled. And doing diligence on either of those types of companies has proven to be a real challenge, because you really need to understand what the steady state is going to be, or have they reached a new threshold? And so people that are stuck doing diligence, understanding how to get banking, how to even make an offer. It's a real challenge to figure out how you can get to an offer that is going to be one that owners are going to engage with, and that's been a real challenge. So if you're stuck in any phase of the deal process, please reach out to us at marketing@K2 Advisor. That's K, the number 2, ADVISER.com. Marketing@K2 Advisor. We'll look at your situation, analyze what's going on, and see if we can help you get unstuck and get to the next level. So it's a real challenge with all the things that are going on out there and the companies that have been impacted positively or negatively. And we're seeing a lot of it, and certainly have the expertise to help you hopefully get through that and get to a good deal. So thanks for being here, and hope you enjoyed today's episode. Hey folks, as I had mentioned in the intro to the show, we are starting to see deal flow come to us for companies that were significantly impacted negatively or positively, but mostly negatively during the pandemic. And the owners were able to stabilize the businesses, and they're starting to show some signs of coming out of the pandemic. And the owners are at a point where maybe they'd like to sell the business. And there's some challenges with that, as we've worked with some of those owners and the banks to see if there is financing that would be available to prospective buyers. Clearly, the banks are being very cautious. They need to see that there's a track record, a month over month improvements, And if they're not seeing that, they are certainly not going to have an appetite to finance those deals. They've got to see that the business is improving and improving steadily, and it's going back to pre-pandemic levels. Well, the historical view of that is probably 2019. So banks are comparing what the business is doing today to what it did in 2019. Doesn't always mean that it has to be 2019. Sometimes, the performance of a business might have been better in 2018. And so they're comparing periods over period, and they want to see that the business is gaining ground and getting healthy again, and has clearly stabilized, so they can understand what the go forward is. Now, I'll say, if you're a buyer, there potentially these are good businesses, and I wouldn't pass on looking at some of these businesses. It's going to take a little bit more time. It's going to take a little more effort. You're going to need to understand what's happening. You're going to have to dig in. But there could be some very good businesses out there that were hit hard by the pandemic, but have tremendous upside into the future. And as far as timing for buying a business, it's a great time to buy a business when you think about the fact that the capital markets are wide open. Banks are there and they want to lend. They're being more cautious, but they do want to lend. Interest rates are at incredibly low levels. So you can get a lot of business for the money, so to speak, at today's interest rates. And then there are incentives. If it's a deal that's going to have a loan value of under $5 million and it qualifies for an SBA loan, the SBA has offered up some incredible incentives, which we've covered in previous episodes, if you can close the deal by September, including waiving SBA fees, paying for some of the principal and interest payments for the first couple of months of a transaction. When you add that up, it could have a significant impact on the overall cost of the deal. So definitely a good time. And these deals should not be just passed over if it's a business that's been impacted. But again, it's going to take some serious diligence and review on your part as a buyer. And if you're an owner of a business, you need to understand that there's going to be a greater level of scrutiny put on your business. The buyers are going to be suspect, and they want to understand what their risk is. And banks are going to really want to dig in and make sure that the business has recovered. And if you're an owner, understand that most buyers want to get and secure bank financing. Nobody wants to write a check for the entire price of a business. It's pretty rare that you see that. Most people, especially today's interest rates, most buyers want to be able to finance a deal. So having your business in a position where it's bank financeable is really critical. And we're working diligently with a lot of businesses right now to understand what the recovery has looked like, and understand if they wanted to go to market today, is that deal going to get bank financing or not? And in some cases, businesses are having to hold on and wait it out a bit longer. Even if the owner wants to sell right now, it's just not the right timing if you can't get a bank behind it. So a lot of that work is taking place. So let me talk about the banks and how they're viewing this. And I will tell you that every bank is different. They all have slightly different criteria and things they're going to look for, and types of deals that they'll do, industries that they'll look at. So, that hasn't changed post-pandemic. That was really always the case. But some of the commonalities now related to pandemic impacted businesses are, I talked about businesses showing recovery. The benchmark appears to be 6 months of recovery. What do I mean by that? Banks want to see that the business has a solid 6 months of top line and bottom line recovery back to the best periods pre-pandemic. So if your best periods were 2019, banks are going to compare a March 2021 to a March 2019 to see whether or not the business really has come out of the pandemic or not. And they're going to watch this month over month. Now, do you need to be 100% back? Probably not. But you need to be showing that the trend is incredibly positive, and it can't just be top line. It has to be top and bottom line. So you need to make sure that even though revenues might be back, that the bottom line is healthy and what it was in prior periods pre-pandemic. So 6 months at least. Now, the 6 months, the magic around 6 months seems to be that the banks are actually not going to close on the transaction. They won't fund the transaction until they see that there's a solid 6 months. It doesn't mean you have to wait 6 months to take the business to market and try to get something done. If you feel like, and you have a lot of confidence and some visibility to what's happening with your client base, and you see the clients coming back and you know the revenue is going to be there and you're confident of that, you don't have to wait to go to market. And buyers, you don't have to wait to look at those deals and try to strike a deal with an owner. However, you may be in a situation where you enter into a letter of intent, the diligence process takes place, the bank looks at the deal, and then you might be in a holding pattern for 1, 2, 3 months, whatever it is, until the bank says, okay, we are comfortable, we see that the business has recovered, and we're ready to fund the deal now. Obviously, it's not a perfect scenario, but it's a great way for an owner and a buyer to lock up a deal and a transaction that everybody's happy with, and then you're just waiting and watching for the recovery to take place, so that then it can get funded and the closing can occur. So 6 months, solid recovery, top and bottom line, an absolute must. Forecast. Banks want to see with some detail what the forecast of the business looks like. Now, this I think is going to be a challenging part of the process. I've been doing this a long time, about 2 decades, and very few smaller businesses really do formalized forecasts. So owners are not accustomed to actually doing forecasts. And if you don't, that's a real skill set. And if you don't understand how to do that, it's a real challenge. And so buyers understand, while that might sound crazy to you and it might be frustrating, there aren't a lot of companies that really do formal forecasts. So this is where a good M&A advisor, a good banker can really come into play. They can help you understand how to look at forecasting. They're not going to do it for you, but they'll be able to coach you through how to look at forecasting, what are the proper elements that go into it, so that you can really sit down and look at the next 6 to 9, 12 months and figure out what you believe is going to happen and what the trends are going to look like. Banks are going to want that. They're going to want to see what the go forward looks like. And that could come in a lot of ways. Signed contracts, maybe you've implemented a new sales process, maybe you get your leads from the internet and you can demonstrate how many leads you're getting and what your close percentage on those leads are, what that means in the way of revenue then and profitability. So lots of ways to approach forecasting, but it's going to be imperative that the parties put together a solid forecast that the bank can review. That will give them a lot more comfort, combined with the improving trend over 6 months. The other thing that banks are looking for is they want to see monthly financials. So a lot of companies have been used to producing quarterly, semi-annual or annual financial numbers. And I have a situation like that right now. I've got a client who really doesn't do monthly financials. They didn't want to pay their accountant to do that. It was a little extra money. So they've really only done biannual financial statements. That's not going to work. The banks need to see monthly financials, and they're going to need to see them going back to 2019 probably, because they need to be able to compare like months. Like I said, they need to see that there's been a recovery. And so if you're comparing March 2021 to March 2019, you need to be able to show the monthlies. And they need to be accurate, both profit and loss statements and balance sheets. So in some cases, that means that accountants may have to go back and do some cleaning up of the financials so they can produce monthly numbers. But buyers and banks are going to want to see this for sure in order to get financing. So might as well get ahead of that now. And then the other thing, I can't say that this has been a tremendous change, but there's clearly more emphasis on this now than there was before. The banks are looking to see that the buyer has relevant transferable experience. Now that's not a new statement. You probably heard that before. But in this case, they are going to put extra emphasis on this. They need to know that buyer really understands this industry. They understand what the impacts were for COVID, the ins and the outs, because in case there's a double dip on the pandemic or whatever, they need to know they have somebody in the operating seat that understands how to handle and potentially pivot quickly. And somebody that comes from outside of the industry may not have that. So again, transferable experience is going to be really key. And I think banks are going to go the extra mile now on making sure that there's comfort around who the actual buyer is. All right, so that's a lot about what we're seeing in the market, what the banks are looking for, what buyers are going to look for. I said I had a couple examples. Let me give those to you now. So you can, really put, live examples to work here. So the first one I'm going to mention is we have a food manufacturing business. And this food manufacturing business was significantly impacted to the negative based on the sector that they service. And so 2019 was an incredible year for them. It was actually a record year. And then the pandemic hit around March and you saw an immediate decline. Everything was hit and the business was impacted the entire year. Actually, even going into the beginning of 2021. And so we've started to see that the business was showing signs of recovery in February. Both revenue-wise and the clients that had disappeared were starting to come back. They were calling for quotes. They were starting to place orders. Now, the orders, though, weren't immediate orders. So the orders were, we want to start back up in 2 months or 3 months or 4 months, but the orders were starting to come back in. And the calls were coming back in. And they service a primary market, but different clients within those markets, and they were starting to see some real returns from some of those client targets. And so you look at a March 2021 to a March 2020, March 2020, and it started to look very promising. April was even more promising. So now we're starting to see the return back to normalcy. They're not back by any means to full numbers compared to 2019, but they are clearly back and well over the performance in March and April of 2020. And now I'm recording this about the middle of May, and we're seeing some significant improvement for May month to date. And again, I'm hearing that the orders are flooding in. The forecast is looking very promising. And so we've got a situation here now where the business really is looking like a strong recovery. And so we have, and the owner has a desire to be able to retire and leave the business. So we now have engaged with a couple of banks, and we're having preliminary discussions. And sure enough, everything that I just covered earlier is happening. The banks have said this looks great. We like the numbers. We like the climb back up. We think that this makes a lot of sense. If we continue to see the numbers increase, we could get behind financing this deal. We've even talked about valuation expectations, and the bank is comfortable with the valuation expectations. They have made it very clear, though, they're going to be looking for a buyer that comes from this industry or has significant transferable experience. So all things that I just covered before are holding true here. And so, what we're finding is that the owner has a strong desire to be able to exit the business before the end of the year. There happens to be a buyer we think is a good fit. And so we're going to go down the path, engage the buyer, explain the situation, see if we can get an offer on the table, hopefully get an offer that's accepted, get into diligence, and then we'll be in a holding pattern. And my best guess is a deal like this could close in about the September-October timeframe, if we're lucky and the forecasts are right and the improvement continues. So there's a good example, and this is a great business. It was a great business before the pandemic. It will be a great business again. It clearly was impacted by COVID. And so very promising, hopefully, for both parties, but banks are not going to write the check until they see the full recovery. So the second example that I wanted to cite was with a distributor. Not unlike the food manufacturer, the distributor actually had an unbelievable 2019. They were doing incredibly well. And the pandemic rolled along, and the business was hit significantly. However, unlike the food manufacturer, we started to see a recovery at the end of 2020. So the good news here is that with a recovery at the end of last year, and improving trends and an improving forecast, and some improvements that the owners made during the pandemic to the business, they made some infrastructure changes to the business that will probably have a pretty good impact on margins on a go-forward basis. So when you model all of that in, we're in a situation where we could actually start taking that business to market today, start talking to buyers, and there's a good chance that we're probably 2 months away from showing that 6 months of recovery. So by the time a buyer comes along, makes an offer, we'll be in a situation where we can accept the offer, get into diligence, and the bank will probably be willing to lend and close on the transaction right away. Again, assuming that we continue to see the improvement and the steady progress, which seems to be the case. And you can clearly see in this business that it was pandemic impacted. And when you see that as a buyer, again, it's okay to go down the path with those businesses. You're going to have to do more diligence, but it's okay. All right, so not to state the obvious, but we're clearly in uncharted waters, right? Most of us, I imagine all of us, have never really experienced anything like this. And so we don't know what lies ahead of us for sure. But it appears that the recovery is happening. Businesses are getting back to some level of normalcy and pre-pandemic levels. And as a buyer, the same adages hold true. Surround yourself with good advisors, educate yourself, pay attention to the details, do the work that's required in diligence, all the work, don't cut corners, surround yourself with smart people that understand deals. And if you do, there's plenty of good deal flow out there if you're looking in all the right places. Sometimes that's a challenge. You need to understand what the right places are. But there are good deals to be had, and I think more and more are going to be there. My sense is that there are plenty of owners who lived through the 2008 recession and now the pandemic. And if they're, boomers, they're probably a bit tired. These are two unbelievably, negatively impacted, in most cases, negatively impacted situations that have occurred. And people are going to be tired and probably wanting to look at a good exit. And so I think there's going to be a lot of opportunities for buyers over the next couple of years. And so good deal flow, just surround yourself with smart people. I hope you enjoyed this episode. All of today's information will be available in the show notes. If you enjoy our content, please remember to subscribe and review our podcast. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.